Tyler, it is our last segment here today, and looking forward to it on Wednesdays. We've decided to start this new thing we call Jedi Options because Tyler, number one, is a huge Star Wars nerd like I am, and like Matt is, many people out there as well. And I say that affectionately. I love Star Wars as well. And Tyler is also the Options Jedi over at Tackle Trading. In many ways, I crafted our Options 101 series, teaches a lot of options content in our courses and labs and all kinds of different things. Tyler, what do you got here for us today? And kind of set this up for us if you can.
Sure. So the pick is Nucor. Steel stocks have been hot. Metal stocks have been hot. Commodity stocks have been hot. Cyclical stocks have been hot. Small caps have been hot. This checks like all the boxes for what's been working of late. And it just had earnings come out. So earnings are now in the rearview mirror. Didn't disrupt the stock. Anytime a company can go from, $50 to $80 and then have earnings and they're like, yeah, it was good enough. We're not going to smack the stock. I like it. I also like, look at the EPS here. 36 cents, 63 cents, $1.33.10. What's not to like about that trend? It's fantastic. I just saw this knocking on the door of a breakout today. So from a technical perspective, that was the first thing that caught my eye. Second thing that caught my eye is I listened to the Trading Justice podcast here recently. You guys just did an expose on implied volatility. Matt, you interviewed Tim. He had some really good comments on how to use implied volatility in the trading. And I thought Nucor was a pretty good example to illustrate the principles you guys talked about in this week's podcast.
Well, I'm glad you listened to the podcast, number one. I'll make sure I go grab the link real quick and drop it in for anybody who did not. And yeah, we did have a discussion on how implied volatility post earnings works. After the crush, you usually will get a build back at some point. And right here on that Nucor chart, like you're seeing down on the bottom, using the implied volatility tool, you can see that Nucor's options are relatively cheap to where they have been historically. Yep. And we are post earnings right here. So we had the crush.
Well, and you also with the low point it made post earnings, you also kind of have a feel that you're at the bottom end of the channel for this time frame too.
Mm-hmm. Mm-hmm. Correct. All right. Correct. And so the signal then is options are cheap. You could try to sell a naked put or a bull put, but you're not going to get paid that much. And so it's not as attractive. What is a little more attractive then is trying to capitalize on this breakout by buying options in some fashion. Now, because I'm bullish, I want to buy calls in some fashion. So the two strategies that I would compare here are just buying a straight call option. That would be like your +3 aggressively bullish, simplest trade. And then the second, we'll be doing some type of call spread, which is more of a compromise, more of a +2 trade, where you're trying to reduce the cost a little bit. Mm-hmm. So the nice thing here, because the options are cheap, I'm not going to have to pay as much, thus my risk is going to be less. These are going to be debit trades, so the risk is what we pay. IV being low makes the pay cheaper. So, first of all, the other thing I like about Nucor is it's got a good history of rewarding breakout traders, breakout buyers,
especially recently.
Yeah. And we're on the verge of completing a month-long base. You take a look at the long-term chart just real quick.
I was going to say, put that on a weekly. You're going to like it.
Yeah, all-time high. Again, what's not to like? And this space is in fuego right now from a sentiment perspective. Everybody loves the space. So, okay. So if I'm going to buy a call, that's going to be trade one. I kind of like the idea of buying a slightly out-of-the-money call. That'll make it even cheaper. And so I went to June. May's a little too close for me. So I go to June, gives me about 51 days. And I was looking to buy the 82.50 strike. Pretty good liquidity in these two. Bid-ask spreads relatively tight. So 340 by 360. So going to cost me about $3.50, which on an $80 stock ain't bad. It ain't bad. You're getting 50 days. You're paying percentage-wise maybe 4% of the stock price to get an upside bet. So if I look at the risk graph on this, the graph's, it's fairly straightforward. It's a hockey stick. My risk is the 350. My reward's open-ended. And even if this just pops, like let's say this just runs to $85. right? Not even that far. A push to $85, and you made a 50% return. So because the call is so cheap, it doesn't take much profit to generate a really high ROI. So just a push to 85 in the next couple of days, if it happens, you're talking a quick 50% return, let alone if you get a decent upswing, right? Let alone if this thing pops to 90 or something. So I think the risk reward's great on a simple long call, looking for a break over the high here. And in terms of stop loss, you could do a tight stop under the 20 MA, or if you wanted a little bit of a position trade, you go a little looser. But that's kind of where my head's on the first one.
Okay. So new core here, obviously, I mean, just to confirm your technical read, I love the chart. I think everything you just analyzed on the chart, I am 100% behind your analysis. A month-long consolidation, potentially into a breakout, great sentiment behind the space, earnings last week. So that's in the rearview mirror. And by the way, bought up after the earnings report. So the initial response wasn't that great, wasn't that positive. But now here we are threatening into the breakout. So buyers came in despite the earnings reaction, which was not bad, but off a little bit, and now we're pushing up higher. So I like that there. I do like the technical read. So going into the trade on the call option, a straight call option is simple, and if you are going to play a straight call option, you actually do need to be that option Jedi, knowing what kind of premium you're paying. Because at this point in the volatility cycle, you're getting a cheaper variation of the option. Now, time decay will still negatively impact it, but as the implied volatility either settles or builds back up over time, which I think there's an edge towards that coming back into its mean, that can at least offset some of the time decay volatility. On the risk graph, you're open-ended now. So call is simple, right? Long call. You own the rights to the underlying equity, 100 shares per contract. At any point at or before June, you can just sell that call back to the market and lock in a profit if it does materialize your profits. So the simplicity behind it is really the beauty here, Tyler, that you're getting it where you're paying for volatility. So I do like it. Matt, any thoughts just on the simplicity of the call first?
Yeah, Tim, I absolutely love this trade. Tyler's right. The space is hot. You got a good technical read. It's a clean pattern with a clean breakout with momentum building over the last 2-3 days, whereas the market in the last 2-3 days has done what? It's
Nothing.
a snooze fest.
Snooze.
It's literally a snooze fest. It's doji, nothing. Lots of news, lots of activity in the market, but the broad market has been a snooze fest. And so you got to like new course price action coming into the potential breakout. I don't think you're coming from too far of a distance to be overextended on the type of breakout. So yeah, I do like it where volatility is. I think buying a call option makes a lot of sense.
Mm-hmm. So what are we comparing it against then, Tyler? Because that's the fun of this one, right? Is we get to take a look at two different ways to play it.
Well, so the one negative you hit on with buying a call is the time decay factor. So I'm capitalizing on the cheap options. I'm capitalizing on the fact that IV could go up, but I'm suffering the negative theta. Well, what if I could make this a spread where I capitalize on the cheapness, I capitalize on IV maybe going back up, and I profit from time decay? If the time decay is a big hang up for you, not wanting to suffer that, because we're not buying a 6-month call. It is a June call option. There's a decent amount of time decay. So what I could do to mitigate that risk, as well as reduce the cost even further, is sell a short-term out-of-the-money call against this. And so if I come into the option chain here, I could sell maybe a May further out of the money call. So I bought the 82.50 for June. Maybe I sell like just a May 20 delta. Okay, pick up 70, 75 cents. That'll reduce my cost almost 20%. And at the same time, so cost goes from 350 to about 290. At the same time, my time decay is now going to be positive. So what this does is it turns it into a bull call diagonal spread. It does cap the upside, but the profit is still going to be, substantial if it can get up towards, 80, 87.50, that short strike. So that I think would be the way here. You can see now the theta is more neutral instead of negative. That's the way I would fix it if I was wanting to be a little bit less aggressive and maybe have a little bit better risk.
What's the profit at 85 at your target? So
gonna
it's
be
about half.
yeah, $82 on 290. So yep.
25,
I'm
30%.
assuming risks would be cut in half as well.
Yeah.
Okay.
Not cut in half, but I don't know, what do we cut it, 25% or so.
Yeah.
What you thought, Matt? I'll share mine first if you want. I like the long call here, guys, out of the two. I completely understand. And I love that you brought up the price slices to look at the difference between how these Greeks would work. Turning it into a positive theta trade, I'm not going to criticize any trader for ever wanting to do that. That means time is benefiting you, not hurting you, right? If that's your instinct, if that's your style all the time, to want to try to find those types of mathematical edges, I would support it. High five you on the way into the option trade. Vega here would still benefit you if you get the implied volatility build. So going back to the analysis we had from, the idea behind the podcast on Monday, the vol build, vol crush, vol is so cheap right now post earnings. It benefits both of them. But I'll tell you why I choose long call for me personally, Tyler. I love the technical pattern enough to be willing to go +2.
Yeah.
On the aggression.
Well, I think by selling the call option, you're not mitigating enough risk versus the return. And quite frankly, I expect volatility to stabilize and build, which means selling the option's not going to benefit there. So you're not offsetting as much of the cost as you probably want to. You're not offsetting as much risk to justify giving up that much return. Yeah. So no, I think where volatility is in the technical pattern, sometimes the simplest answer is the best one, and buying the call option here, I think, is the simplest answer.
I agree.
And the best.
And that's the lesson here, I think, today is that sometimes the simplest answer is the best one. Just exactly what Matt just said. For me personally, I think it is the call. Tyler, which one would you lean towards? I know you're presenting two as a part of Jedi Options here to always give two choices, but which one do you like?
I like the long call. I think one of the other factors we don't talk as much about that might go into my thinking here is, what does the rest of my portfolio look like? Like, if I already have a bunch of cash flow trades on, I like to mix it up. And so I'd lean towards the long call. If I had a boatload of long calls in the portfolio anyways, or already, then I'd probably lean towards the bull call diagonal. But in a vacuum, just all by itself, I like the long call.